Hey, welcome to the exchange. Carvana this morning dropped a massive filing. Let's take a look at it. So this is the 8K that Carvana dropped, which all an 8K is a material public filing. So any kind of information they need to get out to the public, that's how they file it through 8Ks. This is on sec.gov, so you can pull it up yourself if you want to anytime. But really, it's right here. It's the actual information. So on May 10th, 2022, Carvana Co. announced a workforce reduction of approximately 2,500 employees, primarily in operational groups, in connection with its previously announced plans to better align staffing and expense levels with sales volumes. So really what's happening right now is as sales volumes like really top out, we're kind of that peak revenue period right now where the growth rate's not as high as it was, 2020 and 2021, for example. Basically, the only way to really grow margins is basically cut down your fixed costs, aka employees. Which, this is a lot of employees for Carvana. They have about, I think, 24,000 employees roughly total. So this is about, this is roughly 12% of their workforce nationwide, coast to coast. So this is a pretty massive hit. So obviously the employee layoffs are a bigger kind of news story in the media you saw, but I really think the most important paragraph here is paragraph 3, which is actually missed by most of the media outlets. So in connection with right-sizing initiatives, over the next several weeks, Carvana will be transitioning operations away from Euclid, Ohio, IRC, and a few logistics hubs. What's crazy to me because they've been growing for the past, 12 years or so. Just like crazy growth at any cost, spare no expense, etc. Now it's almost the opposite. This might be the peak where, hey, they meet their max size. Also, maybe now they're shrinking down potentially to save costs. And really, as revenues top out, the only thing you can do to really save your margins at all, whatever's left, is really drop expenses. And that's fixed costs right here, which interesting to me, though, is IRCs across the nation. There's only 14 of them. So you're taking one of your IRCs away. Now there's 13 out of 14 left. This is a massive, basically downsizing of Carvana's overall business. So this is from a Carvana's presentation from last April 2022. So really what here is the IRC. So IRCs are just kind of this, looks like the screwdriver and the wrench symbol we see right here. These are inspection and reconditioning centers. So all this means when you sell your car to Carvana, they take it to these IRCs, and from there they refab it, buy parts, apply certain fixes, usually cheaper fixes they can do for low cost. I want to say per car, it's about $1,000 of basically reconditioning they put into the actual the car itself there too, which is why if anything major happening, anything wrong with the car, they won't do any kind of major repairs unless it's very, very obvious. Obviously it won't start or something like that. But if it's cosmetic stuff or behind the scenes stuff, we really have to look into or peer into, they probably won't touch it as easily. But notice here across the entire country, you have 14 IRCs. And really the one that we lost, according to their announcement, is the one up here near Cleveland, which is Euclid, Ohio. Which, look at here, there's 5 IRCs between Ohio and Indiana by itself. I have no idea why they're so concentrated up there, but it's really crazy to me because you have 0 in the northwest up here, but you have 5 right here, and none in the far northeast up here too. So, this might be a smart play for them to cut down their fixed costs, but again, if it was me, I'd probably start cutting some dealerships out here too, because look at the blue the blue marks right here. Either there's probably some of that here that are probably struggling, unprofitable, bad locations, high expenses, etc. So probably my first move, whereas logistics wise, this doesn't really make sense for a kind of a first hit, but again, we'll see. I could be totally wrong there. I do want to add too, according to the CEO, so all 14 IRCs, their max capacity or max rate they can actually do per year is roughly 800,000 vehicles. Carvana right now says about 500,000 vehicles. So what this really shows me is by cutting an IRC out, they're showing, hey, the 800,000 vehicles, the top end capacity range, they're never going to get close to that. They're not going to get anywhere near that ballpark anywhere in the next few years potentially too. So he's basically saying, hey, that target, that goal is way too far off. That coast-to-coast expansion right now is way too far off. They can't reach that profitably. Otherwise, they're going to burn more and more cash even faster than they already are burning it right now. So this might be saying, hey, those dreams are too far gone. And right now we're thinking, hey, profitability and right-sizing the business, which, again, that might make sense. So it's another great slide I think they actually made. So look at total markets at year end. So this is locations. They're saying they have 313 locations across the board. They're thinking that's going to be flatlining, not crazy growth in 2022. Retail units sold, they're only saying 14% year-over-year growth. So again, 2021 did about 425,000 units. This year there might be 470, 480,000 potentially. But look at here, this is a GPU. So this is gross profit per unit. You saw in 2021 that massive spike with obviously used car prices inflated away, and they basically made massive amounts of money. 2022, look at this. It's just massive drops on gross profit. So the front of the vehicle, I'm saying $2,800, which really what's happened in the last, few months or so is really as Carvana's bought prices or bought cars at kind of higher prices, the market's grown, so they'll sell a car for a higher price, so basically make that profit right there. But really the last, 3-4 months, the prices really flatlined a little bit. They dropped in March, rose again in April, a little bit in May, it looks like right now. But they're basically buying cars at high prices and selling them maybe a little bit above cost, maybe at cost potentially too. obviously car vending machines are pretty flat, 2021, 2022. Total revenue obviously is skyrocketed, but a lot of that's just from used car appreciation there too. So again, they're saying here 56% year-over-year revenue growth. But again, I mean, look at the far right-hand corner here. I mean, this is EBITDA margin, net income loss. I mean, you really see 2021 as a kind of that spike where they basically just almost hit break-even EBITDA levels. Net income still slightly negative though, but wasn't as bad. But I mean, as the market shifts and as it turns, I mean, they're going to be in bad trouble. That's why the stock's been down so much in the last 4, 5, 6 months. I mean, it's just been an absolute bloodbath for Carvana. But I mean, again, they're going from basically 0%, almost break even, to negative 11%, 11.6% EBITDA margin. Look at the actual net income margin, negative 14.5%. I mean, this business model just does not make sense. And you think of, hey, like, peak prices and used cars, inflation, kind of the head, peak tailwinds. I mean, 2021 was absolutely it for the used car market. It was 2022. I mean, this could be a trial by fire for them if they're not careful. I mean, it could be very, very bad. Hey, but that was their 8K from Carvana. I mean, I think it was interesting overall, and this could be really a strategy shift for them as they go from like max scale to maybe trying to get max profitability if they can. I mean, it might already be too late. I mean, they just raised $3 billion at a pretty high APR. I think it was like 10.25%. So, I mean, they're still a cash burning machine. I mean, long term, I don't know how they really survive this without changing massive parts of the business model. But again, it might be too late by that point though too. But yeah, be sure to sub, like, comment down below, and that's the exchange.